Assalamualaikum warahmatullahi wabarakatuh. We are from Group 2, are about to present our result in financial data calculation. Uh, our group consists of 4 members. The first one is me, Farah Gifari. The second one is Fatan. The third one is Firdaus, and the last one is Raihan. Our topic of discussion include account receivable turnover, average collection period, debt ratio, operating cycle, and current ratio. So this is our balance sheet, which are taken from the Excel, and this is our income statement too. So we are moving to the first formula, which is account receivable turnover. The function of this formula is to evaluate the ability of a company to efficiently issue credit to its customers and collect funds from them in a timely manner. The formula is sales divided by average account receivable. For example, here we have an example of questions. So like I said, the formula is sales divided by account receivable. And in the table on the side, we have several data, but we only focus on 2 units, which the first one is sales. In the table, sales is $100,000 and the account receivable is 40,500. So in order to achieve account receivable turnover, we have to divide $100,000 by 40,500, and we get 2.47 as the account receivable turnover. The second formula is average collection period, which will be discussed by Fatan.
The function of average collection period for maintains liquidity. Clearly, it is crucial for a company to receive payment for goods or services rendered in a timely manner. It enables the company to maintain a level of liquidity, which allows it to pay for immediate expense and to get a general idea of when it may be capable of making leisure purchase, plan for future costs, and schedule potential expenditure. The formula is account receivable balance divided by total net sales multiply 365.
The next formula is debt ratio. The function of debt ratio is measures a firm's total liability as a percentage of its total assets. In a sense, the debt ratio shows a company ability to pay off its liability with its assets. In other words, this shows how many assets the company must sell in order to pay off all its liabilities. The formula of debt ratio is total assets divided by total debt. This is the example of debt ratio. From the table beside, we will get the total debt of 481,000 and the total asset 770,000. Then we will get the debt ratio 62%.
The next formula is inventory turnover. The function of this formula is to help measure key performance indicators, determine whether the sales may have met the expected performance targets, and help us make business decisions. The formula for inventory turnover is cost of goods sold divided by average inventory. For example, we have cost of goods sold is 75,000 and the inventory value is 31,000. So what we gotta do is to divide 75,000 by 31,000 and the result is 2.419. The next formula is current ratio, will be read by Daus.
For example, account receivable, we get from table on the side 40,000, 50,100 divided daily credit sale to 274, and we get 147.83.
Okay, and the next formula is current ratio. Function to determine the extent to which the company's current assets can cover its short-term debt. If the resulting value shows a high value, and the higher the company's ability to cover its short-term debt. And the formula is current ratio equals current assets divided current liabilities. And we are moving to the example of the current ratio. After we add up, we get the total current assets of 89,000, and we get the total current liabilities of 61,000. And so we put it into the formula for the current ratio. So current asset divided by current liabilities. So 89,000 divided by 61,000, and we got the result is 1.46.
That's it for our presentation for today. Thank you for your attention, and we apologize for any mistake. Assalamualaikum warahmatullahi wabarakatuh.